Right now, at this exact moment, there are seniors across this country, both the ones barely getting by and the ones sitting on a paid off house and a healthy retirement account, writing checks for bills they are completely, legally not required to pay. Not because they are careless, not because they are uninformed, but because every single institution collecting that money has a financial reason to stay silent. And the law that protects you does not come with a notification. 5 bills. And before we get into a single one of them, there is something you need to hear right now, because it is the reason people at both ends of the income spectrum leave this money on the table every year without ever knowing it. If you are a senior living mostly on Social Security, your first instinct watching something like this is that the real money is for the comfortable retirees, the ones with investment accounts and real estate. And if you are a comfortable retiree with a pension and savings, your first instinct is that these programs are designed for people who are struggling, not for you. Both of those instincts are wrong. Both of them are costing you money. For every single bill on this list, I am going to tell you precisely which group it helps, how much, and what to do about it, because the honest reality is that seniors at every income level are overpaying these bills. They are just overpaying them in different ways. My name is Daniel Archer. I am an enrolled agent, federally licensed to represent taxpayers directly before the Internal Revenue Service. I sit across the table from the IRS on behalf of real people, and the pattern I see most often is not fraud and it is not recklessness. It is honest, careful people in their 60s and 70s at every income level, quietly paying bills year after year that they stopped owing and nobody ever told them. That is the most damaging kind of financial mistake because it leaves no trace. There is no bill marked overdue, no penalty notice, no red flag. There is just money leaving your account on a schedule, and it never had to. Now, here is why almost nobody talks about this, and once you hear it, you will never forget it. Every person whose job it is to collect these bills has a direct financial incentive to keep quiet. Your county assessor does not send a birthday card when you turn 65 telling you your property taxes can be frozen. The Social Security Administration does not reach out to tell you that the withholding coming out of your monthly check can stop. The national tax chain charging you $300 for 45 minutes of data entry does not open the appointment by mentioning that you may legally qualify to have that exact return prepared at no cost. And the largest one of all, a brand new deduction worth up to $6,000 per year, is sitting in current law right now. And most of the seniors who qualify will file this year without claiming a single dollar of it. The system is not broken. It is working exactly as designed, and it is designed to keep that money where it is unless you reach out and take it. Being legally exempt from a bill and actually not paying it are two entirely different things. The law does not send you a refund for a rule you did not claim. That distinction is what the next several minutes are about. 5 bills, and then 3 bonus moves for the retiree who has built up assets, because those last 3 are where the serious money is and almost no one covers them. Stay through the end. The first bill is your federal income tax, and this is the one I need you to sit with for a moment, because for a significant portion of the people watching this, the correct amount of federal income tax owed going forward is dramatically lower than what you are currently paying. For many of you, it is zero. And the reason is a provision buried inside the legislation you may have heard referred to as the One Big Beautiful Bill. Inside it is something called the senior bonus deduction, and it takes effect beginning with the 2025 tax year, which is the return you file in early 2026. Here is exactly what it does. Every person who is 65 or older receives an additional deduction of up to $6,000. If you are married and both spouses are 65 or older, that figure doubles to $12,000. And the reason this is so powerful is not just the size of the number, it is where it lands. That $6,000 stacks directly on top of your regular standard deduction. It stacks on top of the additional standard deduction seniors have always received for being over 65. You do not have to itemize. You do not trade anything away to get it. It is simply added on top of what you already had. For the lower income senior living primarily on Social Security, layering these deductions together very likely drives the federal income tax owed all the way to zero. It may eliminate the requirement to file at all. For the comfortable middle-class retiree, this deduction is fully available to single filers with income up to $75,000 and to married couples filing jointly with income up to $150,000. It only begins to phase out above those thresholds and does not disappear entirely until income exceeds $175,000 for a single filer or $250,000 for a married couple. The only people this genuinely does not reach are the very wealthy. Everyone from the retiree on a fixed, modest income to the couple drawing $90,000 a year gets real, tangible money from this. Here is the urgency. This deduction is temporary. Under current law, it exists for 2025, 2026, 2027, and 2028. 4 years, unless Congress acts to extend it. This is not something to get to eventually. It is something to claim every single year it is available. If you file with software, it will ask your age and apply it automatically. If someone prepares your return, verify they applied it before you sign anything. Federal income tax you do not legally owe is the single highest value item on this entire list. And that leads directly into the second bill because the two are deeply connected. The second bill is the federal tax on your Social Security benefits. There is a persistent myth on both sides of this. Half of people believe Social Security is always taxable. The other half believe it is never taxed. Both are wrong, and the difference comes down to a calculation called your provisional income, which is your other income combined with half of your Social Security benefit. There are two thresholds. If you are single and that combined number falls below $25,000, or married and it falls below $32,000, then 0% of your Social Security is taxable. Not reduced, not partially sheltered, 0. As that number climbs, more of the benefit becomes taxable, reaching a maximum of 85% for higher income retirees, which also means that even at the very top of the income scale, at least 15% of your Social Security is always protected. For the lower income senior, there is a strong chance your Social Security carries no federal tax burden at all, and the new senior deduction makes that outcome even more likely than before. For the comfortable retiree with multiple income sources, the taxable portion may not vanish entirely, but the stacked deductions can move you into a lower tier than you are currently in. Now, here's the mistake that hits everyone regardless of income level. When people first enroll in Social Security, many of them complete a form called the W-4V, authorizing the government to withhold federal income tax from every monthly payment as a precaution. That withheld amount then comes back as a refund at tax time, assuming they remember to file. Stop and think about what that arrangement actually is. You are extending an interest-free loan to the federal government on money you may not even owe for 12 months at a time. The correction is straightforward. Look at your actual tax picture or have someone walk through it with you and file a revised W-4V that either reduces or eliminates that withholding so it reflects what you will genuinely owe and nothing beyond that. Pay what you owe on time and not 1 cent in advance as a gift to the Treasury. That is the second bill, and it connects directly to the third. property taxes. This is the one that generates the most frustration once people understand what they missed. And it is also the one where seniors at both ends of the income scale are most likely to assume they do not qualify when they actually do. Start with a concrete example. In Texas, the moment you turn 65, your school district property taxes are frozen at the level you paid in the year you reached that age. Your home's assessed value can double, your frozen tax does not move. And there is no income requirement attached to that freeze. It applies purely because of your age. Texas is not unique in this. Multiple states have age-based freeze programs with no income test, and the comfortable retiree who has spent years assuming these programs are only for lower income households has in many cases been paying a higher bill than the law requires. Now expand that out to the full picture. Senior property tax relief programs generally fall into three categories. The first is income-based, commonly called a circuit breaker program, and it is aimed directly at lower and fixed income seniors. For qualifying households, it can remove a substantial portion of the home's assessed value from taxation entirely, or defer the tax until the property is sold. The second is a flat senior exemption that reduces taxable value regardless of income. The third is the age-based freeze just described, which carries no income test and which well-off homeowners routinely overlook because they assume it cannot apply to them. Between those three categories, nearly every senior homeowner has access to some form of relief. The lower income senior qualifies for the income-based program that can dramatically reduce or eliminate the bill. The comfortable senior, who is ineligible for income-based relief, still qualifies for the age-based exemption or freeze that requires nothing except a birthday. And here's what catches everyone. Not one of these programs is automatic. Your county does not track your age and apply a discount when you turn 65. You have to file, and most of these programs carry hard annual deadlines, typically in the early months of the year. Miss the deadline, and you pay the full bill and wait until next year. Your county has no incentive to remind you because every dollar of relief granted is a dollar of tax revenue surrendered. One phone call to your county assessor's office asking specifically what programs exist for homeowners over 65 and which ones carry no income limit has been worth hundreds or thousands of dollars a year to people I work with at every income level. Make that call. The fourth bill is your Medicare premiums, and this one runs in two directions. One that benefits nearly everyone, and one that specifically targets the higher income retiree who does not know there is a correction available. Start with the one that hits the comfortable retiree hardest because it is the one most people pay without questioning. It is called IRMAA, the income-related monthly adjustment amount. Once your income crosses certain thresholds, Medicare imposes a surcharge on top of your standard Part B and Part D premiums. By itself, that is simply the rule. The trap is in how Medicare determines your income. They do not use this year's income, they use your tax return from 2 years prior. Picture this scenario. You are 64 or 65, still working, pulling a strong salary. Then you retire and your income drops sharply. 2 years later, Medicare reaches back to that old high income return and charges you a premium surcharge based on earnings you are no longer receiving. Most people pay it without question because it is deducted quietly from their Social Security payment, and they assume that if it is showing up there, it must be accurate. It is not necessarily accurate, and there is a specific form to challenge it. That form is the SSA 44. If you have experienced what the government defines as a life-changing event and retirement is explicitly named on that list, alongside the death of a spouse, divorce, or a significant reduction in income, you file the SSA 44, document the change, and Medicare recalculates your premium based on your actual current financial situation. That single form has returned thousands of dollars annually to retirees who had no idea it existed. Now the one that benefits everyone. Medicare Part A, which covers inpatient hospital care, carries a $0 premium for anyone who worked and paid into the Medicare system for at least 10 years, 40 quarters. The overwhelming majority of Americans meet that threshold. Yet some people are paying a Part A premium because of confusion or an error in how their work history was recorded. That is worth verifying regardless of your income level, because if the premium is being charged incorrectly, it is simply a bill you never owed. IRMA correction is the win for the higher earner. Part A verification is the win for everyone. That brings us to the fifth bill, and this one is going to feel personal. The fifth bill is your tax preparation fee. Every year, millions of seniors walk into a storefront tax office or a national chain and pay between $200 and $500 to have a straightforward retirement return prepared. 2 Social Security checks, a pension, maybe some investment statements. And a substantial portion of those people qualify right now to have that exact same return prepared at no charge by professionals the IRS has trained and certified. The program is called TCE, Tax Counseling for the Elderly. It is an IRS program for individuals 60 and older, and it is built specifically around the questions that come up in retirement: pensions, Social Security, IRA withdrawals, and the deductions that apply to older filers. The largest provider of TCE services is AARP Tax Aid, which operates thousands of locations nationwide. You do not have to be an AARP member to use it. Its stated focus is older adults of modest to moderate means, and that phrase is important because moderate means the broad middle, not just the lowest incomes. I am an enrolled agent, which means I am essentially describing a service that competes with my own. But a retiree with a standard return should not be handing a national chain $300 for work that qualified free assistance is built to handle. The clear distinction is this: if your tax situation is genuinely complex, a business sale, active rental properties, a complicated estate, then working with a professional is the correct decision and the cost is justified. But if your return is straightforward, the law has already created a free, qualified option for you, and your age makes you eligible for it regardless of whether you are living on a fixed income or drawing from a healthy nest egg. Those are the 5 bills. Now the 3 bonus moves, and I want to be direct about who these are for. Everything covered so far applies across income levels. These 3 are specifically for the retiree who has accumulated assets: a home that has appreciated, a taxable investment account, a traditional IRA. If that is not your situation, the first 5 already covered you and you can move straight to the summary. But if you have built up something, these 3 moves can be worth more than everything else on this list combined, and they almost never come up in content aimed at lower income retirees because that audience cannot use them. The first bonus is about selling your home. Here's the fear that keeps people trapped. You bought your house 30 years ago for $60,000. Today it is worth $400,000. You do not downsize even though the house is too big and too costly to maintain, because you are certain that selling it will trigger a massive tax bill on that gain. In most cases, that tax bill does not exist. The rule is called the home sale exclusion. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain from federal taxation if you are a single filer, and up to $500,000 if you are married filing jointly. The gain is calculated as the sale price minus your original purchase price minus the cost of improvements made over the years. So that couple whose home went from $60,000 to $400,000 has a gain of roughly $340,000. As a married couple, they can exclude $500,000. Their federal tax on that transaction is 0. They stayed in a house they no longer wanted for years, afraid of a bill that was never coming. The second bonus is for the retiree with appreciated investments sitting in a taxable brokerage account, and it is one of the least discussed advantages in the entire tax code. It is the 0% capital gains bracket. When your taxable income falls below certain thresholds, the federal rate on long-term capital gains is not 15%. It is not 20%. It is 0. For 2025, a married couple can have taxable income up to approximately $96,700 and owe nothing in federal tax on long-term gains. For a single filer, that threshold is approximately $48,000. And that is taxable income, your income after all deductions have been applied. A couple with total income well above $100,000 can still fall into the 0% zone once the standard deduction and the senior bonus deduction are subtracted. Retirees occupy the ideal position to use this because the years immediately following retirement, before required minimum distributions begin, are often the lowest income years of the entire retirement period. That is the window. The strategic move is to deliberately realize gains during those years, selling appreciated holdings while your income is low enough to qualify for the 0% rate, rather than allowing those gains to compound and be taxed at higher rates later. The third bonus applies to anyone 70 and a half or older who donates to any charitable cause and holds money in a traditional IRA. This is called a qualified charitable distribution, or QCD. Beginning at age 70 and a half, you can direct money from your IRA straight to a qualifying charity, up to $108,000 per year, and that amount is excluded entirely from your taxable income. It never appears on your return as income at all. The common objection is that charitable contributions are already deductible. Here is why that thinking falls short for most retirees. The majority of people over 65 take the standard deduction, which means their charitable giving produces no tax benefit whatsoever because they are not itemizing. The QCD bypasses that problem entirely. Because the money is excluded from income rather than deducted from it, it reduces the baseline number that determines how much of your Social Security is taxable, whether you owe an IRMAA surcharge and a range of other calculations. It is mechanically superior to a deduction, and for anyone already subject to required minimum distributions, the mandatory annual withdrawals from traditional IRAs, a qualified charitable distribution counts towards satisfying that requirement. Instead of pulling the money out, paying tax on it, and donating what remains, you transfer it directly to the charity, fulfill your withdrawal obligation, and pay no tax on any of it. Now here's the single idea that ties everything on this list together. In every case described here, the senior deduction, the Social Security tax thresholds, the property tax freeze, the IRMAA appeal, the free tax preparation, the home sale exclusion, the 0% capital gains bracket, the qualified charitable distribution, the law already says you are exempt, or you qualify, or you do not owe. The statute exists. The form exists. The program is funded and operational. But not one of these protections is delivered to you automatically. The government does not issue a refund for a rule you never claimed. No check arrives in the mail for the deduction you overlooked. The system holds that money in place until you reach out and take it. It does not matter where you sit on the income scale. There is a version of this list that is costing you money right now. The struggling senior assumes the valuable breaks are reserved for people who have built something. The comfortable senior assumes the relief programs are designed for people who are struggling. And because both of them hold that assumption, both of them keep paying. You now know 5 bills and 3 bonus moves. More importantly, you know that awareness alone is not the finish line. Every single item on this list requires action to produce a result. So before this year's filing deadline, go through each one. Verify the senior bonus deduction was applied to your return. Check what withholding is coming out of your Social Security check and whether it matches what you actually owe. Call your county assessor and ask specifically about age-based exemptions with no income limit. If your income dropped after retirement, look up the SSA 44. If your return is straightforward, find your nearest TCE or AARP tax aid site. And if you have a home, investment accounts, or an IRA and you give to any charity, the last 3 bonus moves deserve a serious look before you file. Do one more thing. Send this to someone in your life who is over 65 or getting close. A parent, a sibling, a neighbor, a friend. It does not matter whether they are managing on a single fixed check or sitting comfortably on a paid-off home and a funded retirement account. The odds are meaningful that they are paying at least one of these bills for no reason at all. And passing this along could be worth more to them than almost anything else you give them this year.